Time to once again review what's going on in the stock market. And we're going to do it with the help of our research firm MacroOps, like we always do. To start out, let's take a look at China's A shares. And they're worth keeping an eye on because they often act as a lead to the risk on, risk off in the broader market. So if you want to know what the S&P is about to do or the NASDAQ, you want to look at the China A shares. And as you can see right here, they're actually breaking out from a major compression regime. So you had over a year of consolidation here, and then we're finally getting this breakout. So relating it back to the broader market, that's good news. And Chinese stocks in general have been seeing improving relative strength across the board over the last few weeks. And when we talk about relative strength, we mean relative to other indices. But at the same time, China's credit impulse is deeply negative, meaning we should expect a deceleration in growth from that region. Now, why is credit important? Well, it's the same thing that's happening over here, right? The more free money that you pump into the system, the more growth you're going to get, to a point. And China has always been one of the ones that pump the most money into the system. So we've always tracked them because they are a huge factor in global liquidity. And what do we know? Again, with more liquidity, asset prices tend to rise, including stock prices. So the fact that their credit impulse is decreasing, meaning they're pumping less into the system, that's not good for stocks anywhere. The economist Claudia Sahm wrote a post last week discussing how difficult it is for the Fed to actually figure out what's signal and what's noise when they're trying to look at inflation, because they are so worried about inflation, right? Look at this mess. Could you do it? Probably not. None of us could. This is a chart breaking out the various PCE components, showing that the rise in inflation is quite broad-based, so it's not so transitory. We got the FOMC meeting this week, and it's generally expected that they are going to be hawkish, but how hawkish, we don't know. So that could make a big impact on the market. And you can see right here, we're kind of been going sideways for a while, right? And this is the S&P. So if the Fed is too hawkish in their meeting, we might see this break lower. If they come out dovish, well, we'll see it rocket back up. And I'll talk more about what's going on here in a second, but we'll definitely need to keep an eye on that meeting. This chart from Goldman Sachs is pretty incredible. It shows that 35% of the S&P's year-to-date returns have come from just 5 stocks. That's Apple, Microsoft, Google, Nvidia, and Tesla. So you know, if you've been following these videos, we've talked about how breadth has been so bad in the market this year, and this is a great example of that. It's just 5 of the biggest stocks leading the market because they're so big and their market cap is so huge. But look at the remaining 493 companies. They're down here not doing so great. So that's why we always like to look at breadth. You want to see how healthy is the market actually. It's not just always the price if it's going up, at least in the long term. That being said, though, it's going to be hard for the S&P to actually roll over when you have heavyweights like Apple in buy climaxes. I mean, look at this movement, just parabolic. The stock is now 3 standard deviations above its 200-day moving average. And the further and further away a stock gets from its average, the more likely it is going to rebound back. What do we know about the market? It's all about trending and mean reversion. And it goes back and forth between those two states. And mean reversion would be snapping back to an average. Now, historically, this level of trend extension isn't actually bearish, and it actually leads to further gains over the next 2 months. So this 3 standard deviations might get even larger. But again, nothing trends forever, right? It will go back to its average, even if that average is higher, and that's when you got to watch out. Now, as we've already talked about a little bit, the indices continue to be carried higher by a handful of mega cap stocks, but the broader market breadth continues to languish. So you can see this chart of the Russell 3000 right here. If this blue line down here is above this midline, then that means that it's good breadth, that it's strengthening. If it's below, that means the breadth is weakening, and you can see it is far below. It is weakening a lot. Famous market technician Walter Deemer also made a similar point with the NASDAQ advanced decline line. And the advanced decline line is how many stocks are going up versus how many stocks are going down. So he said, although I hate to add fuel to the bearish fire, I'm old school enough to be bothered by this shortfall of 7,411 net advances. So again, you want to see all the stocks moving together when the market is going higher. If it's only a few, like Apple, that means the market internals are weak. Now, you know, we got this rough move in the market recently, but like we said, it was likely going to rebound, and sure enough, it did. Now, the fact that it has rebounded, we expect it to trend to this 4,800 level. Now, again, what happens in the short term, let's see what the Fed says. And we also want to keep an eye on these big stocks. As soon as they exhaust themselves and they stop going up, for example, if Apple starts turning around, you could expect the broader market to follow suit. And remember, this will likely trend higher, but the market internals are deteriorating. We already talked about breadth, but another place you could look at is credit. And credit is this red line right here compared to the S&P, which is this black line. Now, what do we know about credit? Credit actually leads the equity markets. So if we see this red line going down, we should expect this black line to follow. Once again, this is another market internal that you want to look at and understand that, hey, even though prices are going up, the internals are getting weaker and weaker. Now, keep in mind, we have been talking about internals this whole year as the market has continued to trend higher. So it's something to keep an eye on, but if price is going up, then yeah, you want to follow the trend. But this is why why we do this research, so we could game out different scenarios and we understand what could happen. But we don't necessarily act off what could happen, we act off of what does happen. That's why we always use price as the number one indicator. And most importantly, as always, we always have our risk control in place. That's what's going to save you no matter what happens. Moving forward, Berkshire Hathaway is one that you might want to keep on your watch list. The stock is coiling in a 7-month rectangular pattern and teeing up off its 200-day moving average. You can see this is a nice long-term consolidation right now, with the 200-day moving average finally catching up to it. So you see the prices are teeing off both of those, the bottom of the compression and the 200-day. So if it breaks out higher, that's definitely a good one to get into. In the macro ops portfolio, we actually put a short on GameStop and AMC. The pump looks like it's finally going to reverse itself. GameStop is back below its 200-day moving average for the first time in over a year. Plus, the short interest as a percentage of float is at decade lows. So you're not going to be able to get Reddit to, pump the stock and blow out all those shorts because there's not many left. So these stocks might finally fall back down to what their actual fundamental worth is. And fundamentals are important, right? But they're only important in the long term. In the short term, you can get crazy stuff like what happened with GameStop. But long term, it's going to come back down to what it's actually worth. So this is why we didn't try to short this thing during all the mania, because that's how you get blown out. Now that the mania has subsided, we can see that, hey, there's a serious break here. And we know what the fundamental story is. It's not great. This is when you could potentially short. And you can see it has a long way to fall. That's it for our market review this week. If you have any questions, feel free to email me at ak@falliblemoney.com. Myself or one of our team members will get back to you very quickly. I'll see you next week.